That's unlike me, obviously, but I was stuck on a call that I could not shake. So sorry about that. I apologize for any inconvenience that it may have given you. But happy Thursday. Happy Thursday. Stocks continue to rally. We continue to see a recovery in risk. Crude oil, broke back below support. A lot of hopium happening right now. Dollar's kind of mixed. I mean, we're seeing a recovery in commodity currencies, which makes sense. The dollar really hasn't moved a lot. And what I think one of the things that's most surprising to me is Bitcoin is really stuck. I was like, well, Bitcoin's been holding up above 62,000 pretty well. I was thinking that if it's holding up so well, why can't we rally back to 65,000? That just really hasn't been the case. Excuse me one second. Let me make sure that I let everybody know that the Lunch Money Show is starting. You guys got to just bear with me one second. Like I said, I got stuck on a bit of a call. It's a good call. It was an important call, but it was one of those that I didn't anticipate was going to be an hour and 15 minutes either. So let's see here. Just one second. I'm still here. Sorry, guys. Like I said, it's I wish sometimes I wish I had more limbs than I do. Like an octopus. And then also, I wish I was really good at tapping my head and rubbing my stomach at the same time because doing multiple things at once is not always the easiest thing. So, let me see. Good afternoon, Cooper. How are you doing? Well, it's still good morning for me, but it's like I said, it's probably afternoon for you now. Oh, of course it is. So again, I'm gonna reiterate a few things here. Let's look at equities. Equities are rallying. Again, the market's on hopium, if you will, and I say hopium. The reason why I say that is because the market's anticipating that whatever hostilities that we've seen between the U.S. and Iran, it's over for right now, and it's not going to be, it's going to be set aside. But remember, there's been more payload bombs being dropped between the U.S. and Iran than we've seen since basically when we had our first ceasefire. Um, and we are going into a weekend. I mean, today's Thursday, obviously, but we've got 2 days, and the memorandum of understanding seems to have stopped for right now. So the question is, are there going to be more hostilities over the weekend? And if there is, will the market get ahead of that, if you will, going into the next, uh, you know, 24 hours or so? And that's kind of what I'm thinking is, what does the market do? Does the market say, you know what? Nothing's going to happen. We're going to buy equities and we're going to be right back at all-time highs? Or does the market play a little bit more defensive and say, instead of going to all-time highs here, the market says, you know what? We might get some more hostilities over the weekend, so we're going to turn. And I think we're at a pretty important inflection point as we go into this afternoon. And I'm just talking about the S&P in general. So with that being said, let's go look at what's happening in other markets. Let's take a look at what's happening in the dollar index. So the dollar index, you can see, is down a little bit today, but it's also in what we call a channel. Could be, you could identify it as a flag pattern. If you want to go that way, let's draw a little bit and do a little bit of work together. How about that? Let's delete that, delete that, delete that. Okay, so now if you want to talk turkey with me, if you want to talk technicals, we have a bull flag pattern that could be developing like this. If you take just the entirety of the move, whenever I'm looking at charts, one of the great things to do is, how you're looking at something and you can blur your vision. When you look at a chart, blur the chart, and then if you blur the chart, you'll notice that the moves look more like this, right? if you're just like, oh, there's one move down, there's a big move down up there, if you blur in your vision, you're just kind of, averaging out everything. So that gives you a little bit better idea of why I can see this as being the actual flag pull. So if that is the flag pull, and we can't read too far into it just yet, but if that is the flagpole of the dollar index, that means that should we get a reaction, which we already have, but we get a reaction from 100.65, which I know is support. You guys all probably know it's support as well. We talk about it on the morning edge. You can see we draw this out every day, our bias chart. So you'll know support is 100.65. The reason why there's an asterisk there is because it's important. We all know it's important. All of our traders do. So as a result of that, we know that this is a pretty big breakout point. And as long as that holds, we got to stay constructive on the bullish side for the dollar. Chris, I'm bringing you over right now, buddy. I see your message. So let me go ahead and bring you over. So now I'm not going to get super excited about the dollar unless we get above, this 101.30. And if you guys know where that's at in euro terms, it's pretty simple, right? Below 113.80 or 90, excuse me. That means that if the euro breaks through 113.90, which is right here, that's when we'll know that, the flag pattern is in play, right? So when you look at the dollar index, you go, well, the dollar is holding up pretty well. The euro is obviously weak. So I have to take that into consideration, because what happens if stocks actually do not make a new high, which again, we are approaching those highs, right? But let's say we don't make a new high, which you can see here, then the beneficiary of that move is going to be the dollar, because if stocks come down, the dollar probably will move up as a hedge. So that's one thing that I'm looking at. Again, a couple of other things that I'm thinking right now is the gold and silver markets, precious metals. Gold's so close to 4,000 that it's hard. If it's a summer month, yields are strong, but they're at resistance. I say that like without showing you. So let me show you what I mean by that. So yields are strong. This is a 10-year chart, right? Yields are strong. You got this flag pattern, but it's also summer. There's a lot of resistance up here. This is all going to be really big. So are you really wanting to push the envelope right now without any, reasoning? That's what gold traders are probably seeing right now. They're like, no. So I don't want, if yields aren't going to pop out to new highs, and I don't see any reason for them to do it right at this moment, then I don't see any reason for gold to necessarily break through 4,000. And silver at the same time, is approaching that big $50 level, or $55 down here. I don't see any reason why I should, go down and break that immediately. So you're getting a consolidation. Again, that has to do with yields, probably has to do with the dollar, which also has to do with equity. So when you tie it all together, it's kind of what I'm seeing right now. So I'm gonna be quiet now, and I'm gonna bring in Chris Pulver. How you doing, Chris?
We're good, man. How are you today?
Happy Thursday. I'm good. I'm hungry. I haven't eaten since like about 13 hours ago, and I feel like I've been on calls nonstop. But other than that, I'm doing good.
All right, all right. Well, I'm just watching this slow freaking melt up all day, and still not getting a premium to get the trades that I put in from this morning. And that's okay. I bailed on a little bit of a dead zone trade earlier, took a $15 loss, which was my executive decision. Right now, it'd be pretty much showing 80% profit, so that is very frustrating that I bailed on that one. But I'm curious where the day is going to go. We still have that 7-day range. I've talked about that a lot, and it's still in the same range. The market's respecting. Let's see if we hold below 7540 today. I'll bring the chart up here. So if we hold below 7540, here's SPX 500, and this is the chart I'm using. So here is today's candle. So markets are up on the day, yippee skippy. S&P's up 0.7%, NASDAQ up over 1.5, Dow's up 0.3, Russell's up 1.26. We're still in a range. Coming into Friday, are we going to stay in the range with another stall and pause and rejection? Are we going to drift higher into Friday? A lot of the highs are made on Thursdays and Fridays, so we are making a nice little weekly high today. This is Thursday, Wednesday, Tuesday, Monday. So we're not quite at the same high from Monday. This does make like kind of the structure of the week pretty interesting just because we haven't gone anywhere. Like this is where we opened on Monday and we're just higher than that today. So if the market kind of stays with this positive gamma, we'll see if 75.40 is resistance or if it breaks and it allows prices to drift a little bit higher. All-time highs at 67.20. So tomorrow makes a big difference. But for the rest of today, the crappy part is now that it's 12:42, it's like I don't have enough time premium to really get the trade that I want. I am looking at something. I want to build this out with you now. I do think that today I'm looking at something where if we kind of cap out around like 75.50 or 75.60, I'm going to look at a lower risk and higher reward setup to kind of take the day in with some type of cap on the day. So let me build that out here. Let me see if I can do. I could just do like a bear put debit spread, but I'm gonna have to get
explain what a bear put debit spread is.
I will. Here's what's gonna have to happen for me to say I want to take this trade. I want to see price probably all the way up to 75.50 or 75.60 today. So let's say that step number one. Everyone see my screen here. So step one is SPX at let's say 7550. Okay. I will likely buy the 7550 put and then sell the 7545. Now that debit, I want this to be less than $1 debit. And if that's the price, so that's what I'm saying. If price goes higher, a little bit higher, I want this trade to be about $1. That gives me a $4 potential winner. So if price does get up to, let's say 55 or 60 and then falls back below 45, I can make $4 to risk $1. So I'm essentially, Blake, trying to call the top on the day. But I know that realistically, the top is probably closer to like 75.50 to 75.60 based on what I'm seeing right now this morning. So we have a decent call wall around 75.50. The gamma is getting pretty noisy in here. So, 75.25, 75.50. Both of these could be achievable targets towards the end of the day. It's rare for a day to go all the way up and stay at the highs for the entire day. Usually if we get up to the highs, we give a little bit back at the end. Yeah. So especially if it's somewhat inefficient on the day, which if we get above, I think 36 today. If we're above 75.36 today, I would categorize this one as an inefficient day for the S&P, which I trade a lot of this stuff. So anyway, if price can slide up just a little bit more up here, I want to see if it will then sell back off. And so I'm looking for a higher reward trade and a low risk trade. The other way
just a little punch above the highs then.
Pretty much. I'm looking to see if we will punch kind of like this, dude. If we punched above the highs here and we gave some of it back, if we punch above the highs and give some back, I'm going to try to tackle that at the end of the day for a low risk trade.
Okay. All right.
That's what I'm looking at intraday. Okay. Structure wise, we're not really giving anything up. If we go to, the NASDAQ, this is still, off the 50-day moving average, a nice little bid, but okay. So what do? We just keep grinding higher in the NASDAQ until we hit all-time highs. Maybe this is the look. If we get here, we get here. Even though this is a crazy 30% move, is this an ascending wedge? And what gets us there usually is a break to the upside. I don't know if that's the trade, but that's what the technical pattern would be if that's what we do. If we get to all-time highs and we stall, there's resistance, there's support. I guess you could like draw the wedge this way, but how do you feel about this, Blake? If you have a wedge like this, I don't like to say that the bulls are really going to take full control there, because oftentimes what I see is the market still respects these sideways levels. And so we break out here, and if we pull back and hold, then sure, we have a room to run. But a lot of times I see the market do this, come back to the halfway point, and you're no better off than where you started. This wedge is just a head fake, and you're still just a range trader.
Well,
so just something I'm cautious of.
Yeah, and in Elliott wave terms, that would be like a flat, or if it's a completion once you come out of a triangle at the top of a strong move. This could be an ending diagonal. So
right,
it's one of those things that I am a little bit nervous, especially because of how far we've traveled in recent months. So I think you have to be really cautious on the upside on breakouts. If you're going to be long, just get long on dips, because if you're wrong with a much lower risk.
Right. No, I get it. All right. Well, let me see right now. This might be worth looking at if I did a 30, 35, 45. If I'm calling the top today, it's still not a lot of credit though. I don't like that trade. I was going to build this out, see like maybe a little profit trap up here. I don't know if this is the top though. We have better resistance around 40 to 45. So I think if I'm calling the top today, it's going to be something around like that 50 handle. I think 50 handle, if I'm calling that as my top, that's kind of where I'm willing to stick my neck out there and see if I'm going to get paid. Now I could be wrong. And if this market comes back from here, where we basically, hit the expected move for the day, market starts to revert, then okay, fine. I'm going to sit up here with pending orders. I'm not going to get filled, and it's just going to be another patient day that price didn't come to my window. I set a lot of my trades out where my risk reward is what I want, not what the market's going to give me. So case in point is I put a trade on this morning that I'm asking for $2 credit, and at one point I saw like $1.20, and I had a lot of traders who were like, "It looks good, let's take it." And I'm like, "No, I'm not going to take it." It's because the other side of that trade was like risking $1,800. And so you're asking me to risk like 1870, 1880. And I'm just stubborn like that, where it's like, I'll risk 1800 to make 200 and then play defense. But I'm not going to settle for like $1.20 and then have less wiggle room as far as my defense goes. So anyway, it's been directional today. I'm just kicking myself a little bit for the trade I put in yesterday. This red box on my screen, like this red box, I needed price to be above this box or below this box. And so today's price action being above it, that was that's shaping up to be a nice winner, about $130 a contract. But I bailed on the trade and I took a loss of like $15, and that's on me. So anyway, let's see where we are in futures. We had a lot of noise this morning.
Wait. You didn't make money in every trade that you do? I'm gonna log out right now.
Yeah,
right
I know.
now.
Just shut it down, dude. Shut it down.
It's over.
Yep.
Hey man, I got wiggled out of sterling pound dollar short last night. I came in, swiped my stop, and I got up this morning. I'm like, damn it, it just stop hunted my ass.
Yep.
It's so irritating.
Dude, you know what's funny is I wish, and I know that you can do this with binary options, but I do wish that if I could trade, currency options the way that I trade stock in index options, I would trade them all the time. Because of the exact reason that trade would not lose if you could trade options where the time is your friend, and it's just like at a certain point in time, is it above or below that level that you need it to be? And that to me is a much easier trade.
I get so jealous of my European friends, and they're just like, "Yeah, I just bought some options on yen," and I'm like, "God, I know you." I mean, we could do it with FXY, I'm sure, but doing it via spot, it would be so much easier.
Agree. Well, I mean, things are moving in that direction where it's like, pattern day trading is gone, and there's going to be potentially like multiple sessions now through a trading day, 24-hour trading type stuff. It could evolve. I mean, if U.S. traders can have spot forex options, that'd be pretty awesome, man. I would love to build out those trades and see what they look like. Because it's like trading options is kind of like having a sandbox, and it's like I can just think of the trade on my chart, take a trade and construct it, set up the reward to risk the way I want it. I love that stuff because I see constantly in forex and constantly in futures, the market likes to wick and test and run. But like ultimately, when you look at the bigger picture, the noise, you're generally right on your technical analysis. But like in the finite, scalping of like 5, 10, 15-minute candles and that little like swing structure in 1 and 4 hour charts, it can be pretty noisy. Yeah. So anyway, but you accept the playing field as it is. And if we have options, I'll probably trade a lot more currencies outside of the passive stuff I do now with, holding and accumulating like I'm doing on the Swiss pairs. I'm still long, the FXY. The trade that I talked about, I think it was last week, Blake, I talked about that DBC trade. It's up about $1.10 since I took the trade live with everyone in our Lunch Money show. I think it was last week. So this trade's not bad for dollar cost averaging. I bought 26, I think 26.50. It's written down here. Let me see. There it is. 26.50 filled another pending order at 22.05. This to me is, I want to see if this will be either this is the pullback to go higher to symmetry at $40 price target, or this is a pullback towards the lows and we have a flat pattern. We just trade this from level 1, level 2 back up to the highs, and I'll take profit there. But I still think this is a breakout to $40+. So let me ask your thoughts on oil for a second. I think is Jim coming out with you today?
No. Oh, Jim is, yes. Jim
Yeah.
Jim will
Okay.
be here. Yeah, he actually just sent me his charts just a moment ago.
Okay. Awesome.
So I'll have Jim, and I'm a little bummed out because I had for the for those of you that are trading analytics subscribers, you saw there's a pattern in play, and from the sub 70 level, and I thought we would trade all the way up to $79, the breakdown point,
Hmm.
but what we couldn't hold today is the 7250, and so once we drop below that, it invalidated the trade, which is still up 4%, but it's like I'm a little bummed out that the crude oil market just came right back down again. It's a bummer.
Well, why is that, Blake? Why'd that happen? What happened?
Oh,
What's the
what?
difference between yesterday and today? Huh?
Yeah, well, that's the thing. It's like, okay, well, okay, again, it's going to be to before you got here, I was just kind of explaining to everybody, um, why is the market up today? The market's up today because it's the market hopes a lot, and we're in the hopium market. We hope that all the hostilities that we've seen over the last 48 hours, they have come to an end.
Yep.
And so everybody's like, okay, that's it. Trump's not he's not pushing in ground troops. So look, everything's going to be fine. We're going to be back to peace talks. There's no more bombs dropping. So the little spike that we saw in crude oil, it's going to come down. Stocks can go back to all-time highs, blah, 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 blah. I think
Right.
that's where the market's at.
Yeah. I mean, it was, I guess you can call it a taco trade where it's like, it was, deals off, attacks resume. And it's like, and now they want to do a deal. It's like, okay, man, we're only 100 some days into this, with the same song and dance. So I just, I too thought that oil is maybe going to work its way, and maybe it still has some pump into it, but I think right now we are probably, I don't know. I'm curious what you and Jim think about this, but I'm thinking that most likely we're going to see like $60 to $70 oil, and that's going to be the new normal. I don't know if oil is going to hit highs or it's going to break down to $40. Like, I think we're just going to have this new normal of everyone can live in peace and harmony from, let's say, $60 to $75 or $60 to $80 oil. The world can, not want to kill itself if we have oil in that range.
Yeah.
But it's a big change from what was up here when everyone thought we're going to 250, right? But we didn't. And why? Because everyone forgot about the SPR. Everyone forgot about global supply, that it's like when China started dumping SPR, and so did we, and the whole world was now they're looking to rebuild. It's like, I get there's likely going to be a case for sticky oil, but I just think that SPR was there were way more reserves than we thought. We depleted the crap out of them, but that
Yeah.
also is what contained the oil shock as well.
Yeah,
So
and
it's
that's
funny,
and
man.
that's Tracy's whole argument. That's why she thinks that oil goes higher from here, which I'm not going to disagree with. Unfortunately, the price is just not responding to that. But hey, Chris, I want to ask you that. Well, let me stop for a second. Yeah, guys, if you're listening to us on YouTube, give us a thumbs up. If you're listening to us on Twitter or on X, the little hearts is great. Retweet, share the word, share the love. If you see a link, retweet it out. It'd be great, to get more people to listen to the Lunch Money Show. Remember, this is our first month doing this show, Chris, and we have several hundred people that just listen in just on Twitter alone. So and it's the summer when everybody's traveling. So we appreciate all of you
Yeah.
guys' support. There is a question that came in from AJ. He says, "Hey Chris, when you take back ratio trade, do you wait till the expiration to take profit or close it out early to free up the margin?" Well, let
AJ,
me let me just answer that, AJ. For Chris, Chris trades a 400 bazillion dillion account, so he doesn't even care about margin. How about that, Chris?
I
Is
mean, I
that
do care about margin. I do care about buying power. I think AJ's asking about my Pepsi trade. Type in where, yes, AJ, is it Pepsi you're referring to, that ratio spread I took? The put ratio spread? Because if
Yeah,
that's the case,
let's
I
just go
pulled
with
in.
that.
Yeah, I pulled in the dollar. I think it was a $1.25 or $1.50. Let me double check here. Pepsi was a $1.55. So the way I'll close out that trade is if it's showing like probably a 30-cent debit or less, I'll take it off. It depends on how much time's left in the trade. If I'm at, let's say it's November, December, and I'm still at like 25, 30 cents, I'll probably just sit on it till January. But if it's like September and it's showing 25, 30 cents, I'm not going to sit on it for 5 months to make an extra $30. So I'll just close it out and take the like $1.25 net per contract. So
And he
if
was he
this
was
to me
also
is
talking about DRAM
DRAM,
too, that you
yeah,
talked
DRAM.
about on. Yeah, 2 days
Same
ago.
thing. If this is under 20 cents credit or 20 cents debit, I'm probably taking it off. Like when I'm over $100 per contract in this one, I'll probably take it off because I'm going out to Q1 next year. If in the next 3 to 6 months, this is, 30 cents by September, I'm probably
Yeah.
just going to take the $100 and just give me the time premium back, and let's see where DRAM is at.
All right. All
So
right.
yeah, a lot of those trades I'm looking at like 80+% of that credit, and then I'll protect it. And that usually gives me a lot of time and buying power back. But if it's within like 30 to 45 days of my expiration and I'm way, way, way out of the money, I look at my option chain and my 99% chance of profit, I'll probably just sit out until close, because that ratio spread also builds out those profit traps. Here's an example, Blake, and I know I'll let you and Jim run, but this trade I had, this was a wild and hairy trade here. CBOE, this is a ratio spread I took from like May to June, and we had a low here at 226. Now, the crazy part about this trade is I had the trade put in right as this was falling. I did a 280 by 270, pulled in $1.50. This trade got filled, and I want to say 24 hours later, it was already up $100 because we had such an aggressive bounce off those lows. And so of the $1.50 credit, I closed it for 50-cent debit and took the $100 a contract, and I got done. I was done with the trade. Now, I said for fun, I'm going to monitor this thing because as we came into expiration, this trade was actually, this is June 16th, this is June 17th, this is June 18th. The close was 249.10.
Okay.
Just give me a couple more minutes here. So 249.10. 249.10 was the 618 closing price. So that means I am assigned at 270, less $10 on the profit trap for my ratio spread, and then less the $1.50 on the credit. So my break-even price is 258.50. Now, with the price closing at 249, what I had to consider is, and this is if I'm still in the trade, if I still kept the shares, could I repair this with a covered call? And so if my break even is 258.50, and let's say that I sold a 260 covered call, right now we're trading at 265. So this trade could get called away. I could have my 258.50 break even. I could sell a covered call and lower my cost basis by another $2, $3, $4. My break even might be 255. I get it called away at 260. I flip that win for like $500. But the crazy part is it still went lower down to 226 or so. That's a little bit of a drawdown, but it came right back up, and you think it's called away for repair. So that's kind of plan B for me, which is plan A is the ratio spread. Plan B is if I'm willing to own it. I mean, this trade, by the way, this is CBOE of all things, and this volatility was down 38%. That's rare for the CBOE or for any individual broker. The CME, like all these, they don't really have that type of volatility, but at this particular time they did. And I'm not really sure what this was outside of, all I could really read out here is like prediction markets. It is something with prediction markets, and it was right around pattern day trading, so it just became a very noisy trade. But nevertheless, we had a win. It was fine. I'm happy with that. But
No,
there's
it's good.
always backup plans. So anyway, all right. Happy trading, everybody. You and Jim have fun. I'm going to see if I can get that trade to short off that 75.50 handle today. Maybe I can get a low risk, high reward setup, and I'll see you guys tomorrow.
Hey, I love it. And I love your tactics here. Let the market pop to new highs and then fade that high and get set up for a good trade. And if you have any luck here, Chris, maybe what will happen is what we talked about earlier. People start looking around and going, you know what? We're heading into the weekend. There could be some aggressive action into the weekend, and maybe I just don't want to be long so much, and maybe that'll work out in your favor.
Possibly. And, for this range of 7 days in a row, perhaps it's the same thing I just talked about, which is we just don't go any higher than 74.40 or 75.40 or 75.50.
Yeah.
Maybe.
I mean,
so we'll see, man. It's otherwise today's day 8. We're still in this range. And if the market breaks above it, okay, there's some confirmation we can talk about.
Sounds great. All right, Chris.
Okay.
Well, thanks for joining us today. We really appreciate you. I'm going to have to take back over the charts.
You got it, man.
Here. Thank you so much. And Chris, have a great day. And Jim Welsh Macro, or Jim Welsh from Macro Tides is here. Jim Welsh Macro. That like just
hey, I'm not that big, okay? Come on.
I didn't say Jim Welsh fatso. I said Jim Welsh Macro. How you doing, Jim? Good to see you.
I'm doing well. How you doing?
Well, we're in an what I like to call it what I've been calling all week. This is kind of uh, just a like kind of a lull before probably what's going to be fairly crazy this next week as we kick off earnings. We have inflation. We have a Fed meeting coming up in the next couple of weeks. So this week has been a transition week, is the way I was defining it. How are you seeing the current market conditions right now?
Which market do you want to talk about, or just in
Ah,
general?
just in general, how you feeling
Yeah.
about us just poised here at the highs, especially after all the aggression that we've seen from the U.S. and Iran?
Well, what's interesting, and we'll talk about it in greater detail. Last Thursday, when we spoke, my expectation was we would see a rally on crude to 74.50 to 76.50 for a wave four. Well, the news brought that about. Expectation was that we would see the S&P drop below 74.27 to complete a sideways chopping period. It got to 74.21. The expectation is we're going to new highs. Gold, the expectation was we're going to see gold rally. So overall, the markets, in terms of the chart analysis and such, Blake, have really kind of fulfilled what you and I talked about last week, which is all the more reason why more people should tune in. So if you are listening, thank you. Pass the word around. And if you want to get last week's weekly technical review, Jim Welsh Macro at Gmail. I'll be happy to send it out.
That's right. And I have to say, Jim, your technical reviews are awesome. So and also your the just all of the information that you send out, guys, just realize it's not some AI slop crap. Jim puts in a lot of effort and has for subscribers for years. And we've been doing these videos together for about 5 years now. So
Yeah.
it's always great to get, kind of set straight with Jim from a macro point of view moving forward. So with that being said, let's jump into some of the charts that you
Yeah.
brought, Jim. And I want to talk about, well, I mean, everybody wants to talk about inflation expectations and why the hell is this such a big deal?
Well, because the Federal Reserve and the members of the FOMC put a lot of emphasis on inflation expectations. Their belief is that if people begin to expect more inflation, then in effect, they're going to spend more sooner rather than later, creating demand that then pushes prices up. So for the Fed, this is a big deal. I'm not really in that camp because, as I've said before, if you don't have the money, you can't spend. And for a chunk of people, that is the case. They're under the gun, cost of living is high, and so forth. But the Fed pays attention to this. And the point being is the 1 year and 3 year, the Fed probably weights the 3 year a little bit more heavily because the 1 year does get influenced by things like oil prices, gasoline prices. But look at the date, September of 23, June of 22 on the 3 year. So this is something and why there's a level of concern on the Fed. And the minutes that came out this week just added more emphasis to what you and I have talked about since the last meeting, that there's a group of people on the FOMC that are definitely more worried about inflation than the labor market. And last week's jobs report didn't change that in any meaningful way.
Jim, sorry, we just came off a 30-year auction and it was a good auction. And yields are probably coming down just a little bit on the longer end of the curve. But the 10-year yields, and I know you're going to talk about
Yep.
actually today, you're going to talk about the
Yeah.
treasuries, the 10-year yield. They have looked so strong. I mean, at what point is the market going to take notice of these higher yields?
We see it ticking. If you get above the high, recent high was 468 on the 10 year, Blake.
Yeah.
You take that out, that'll get attention.
Okay.
And what's happening in the US, I think in part, is what's happening in Japan. Their 10 year yield is up to about 290. That's the highest since 1996. Think about that, 30 years ago. So, and yields in Europe have also been pressing up. So I think the magnetic pull of global yields is why our treasury yields have been working their way up, and the 10-year got above 456, which was a number I thought was important. And it's as we'll talk about it, we'll go through why. But I think that's what's going on, Blake, is global yields are pulling the U.S. Treasury yields up. In addition, there is still a lot of supply every single auction.
Okay. All right. Well, it's like it seems like unlimited supply, and with this Treasury Secretary, he's got more unlimited supply to hawk to everybody, right? So,
Yeah.
so let's talk about the FOMC meeting minutes. You said it's the most hawkish since 2022.
Right.
What is I mean, who gauges that? That's like when I'm watching the World Cup and they're like the momentum indicator. Like, what is the momentum indicator? Somebody explain that to me. It's like,
Well, this is an output called Augur, as you can see, Augur FOMC sentiment indicator. And
yeah,
what they're doing is they're looking at the minutes, and I'm sure what they're looking at is the different adjectives and adverbs that are being used during the discussion between the FOMC members and how they're all summarized. Also, did all the all participants, many participants, most, I mean, that's all that stuff when you go through to come up with something like this. And it tells us, it just reconfirms what you and I have been talking about. If you look at the dot plot and the summary of economic projections, all of that tilted very strongly, more hawkishly in June versus March. I mean, in March, you had 12 people talking about rate cuts. In June, you had 9 people talking about rate hikes. I mean, that's an incredibly dramatic shift in
yeah.
just 3 months. So this is just reaffirming what kind of what we already know, but I just thought it's kind of a cool indicator, cool chart. And you can see as it
Jim, it's
rolled over, that's when the bond market peaked as that started to roll over. So
it's
that's
as cool of a chart as the momentum indicator in the World Cup games. Just
nothing can
kidding.
compare.
Just kidding.
Blake, you do that a disservice by having them in the same sentence. Okay,
All
can't
right,
do that. All
let's
right.
talk about you think there's inflation relief coming. I mean,
Yeah.
I'm a consumer, you're a consumer. We spend a lot of money on crap, and it's
Right.
like, what kind of relief is coming? Explain to us.
Well, the headline, which is why, if you look on the far left, you see a headline going down. The relief is going to be the month over month increase was 0.5% in May. I think there's a good chance it'll drop to 0.1. That's a fairly significant. Why? Well, of course, we all know why. Gas prices came down a lot, oil prices came down a lot. And so the year over year number, I think, has the potential to drop from 4.2 to 3.9. Well, getting below a round number like 4, that'll be attention grabbing. To your point, Blake, look at the core. The core probably will be pretty close to the same. Why? Because it doesn't have energy in there or food, and that's not going to be affected by what we saw. So I think the headline number is going to be like, wow, okay, inflation is coming down. And then people will look at the core and say, yeah, but there's a hell of a spread between 390, what I think potentially it will be on the headline year over year, and 290. So, the headline is going to show, oh, okay, we are getting some relief. And, I think the markets will, on balance, find that favorable because it it will be perceived as, well, that takes some of the heat off or some of the concern that some FOMC members have. And of course, the expectation is the next 2, 3 months after the June report, we're going to see even more relief. So,
Yeah.
and I think it has implication for some of the markets, from the perception that, gee, the Fed won't have to be so aggressive.
All right.
Now,
Well,
again, I'm in the camp that they may increase in one. My take is they're going to just stay flat,
yeah.
because we get the inflation relief over the next 2, 3 months. That gives them the leeway to just say, you know what, if for the hawks to say, you know what, okay, inflation is starting to come our way.
Yeah.
Uh, Now, as an aside, maybe the New York Fed did an analysis of tariff inflation, And a number like Warsh and Number and Powell, all were saying coming into this year, well, that's going to kind of wane. Well, what the research by the New York Fed found, Blake, is that half the companies that they survey still expect more inflationary pressures from the standpoint of them raising prices. So that's going to linger maybe a little bit more than I think some people on the Fed were expecting. Again, I don't think that's going to cause them to rush out in July and August, or pardon me, July and September, the next two meetings. I think they're not going to do a thing.
Okay. And if they don't, I mean, that's just fodder for them for equities to hit new all-time highs, Jim. That's all it is.
Yeah,
So,
yeah, yeah. It's a one hurdle we don't have to worry about.
right. Okay. So here we got crude oil. The crude has been heavy as all get out. I thought I would expected a lot more from this,
Sure.
aggression in Iran. Not the case. How are you reading crude?
Well, the title on this chart is the same title I had last week. Okay, I just figured, well, I can't change it, right? Because it did it. So what we noted was that the crude oil was oversold. You had a very, very small RSI divergence down there. But more importantly, what I was going off of, Blake, from that high of 100, and this is the August crude contract. So as we flip to the next contract in a couple of weeks, these numbers are going to change because that's what happens with the futures. But anyway, one down, the rebound to 98.42 was wave two. That very progressive, impulsive decline was wave three, which is what I thought we were nearing the end of that. We were going to get a bounce to that 74.50 to 76.50 number. And then if the way I'm reading this pattern is, I do think there's the potential for one more decline that'll take out that low at 67 and change, and it'll set up even a bigger RSI divergence in all likelihood. And then that will set up a much larger rally.
Okay.
Once you complete five down, now you're going to get a retracement of the prior decline. So if it bottoms at, I'm going to use 66 just as a round number, it will have declined from 100 to 66, $34. Well, immediately take, well, what's half of that? That's 18. What's 18 and 66? 84. So
Okay.
oh, and then you look at the chart. Wow, look at all that resistance. 84.55, 80, in other words, intraday lows. So my take would be is if this pattern fulfills, you want to be a buyer below 67.04 in anticipation of a rally that gets up to 82 to 84.
So, Jim, I'm going to ask a question that I think I know the answer, but I don't know if everybody else knows the answer. Why wasn't this one and this two and this three?
Well, because wave two is never, ever supposed to be higher than the top.
Okay, so that's the top. The top marks wave one, wave one starts here.
Correct.
Okay, all right, all right.
Correct.
So that's 1, 2, 3, 4,
That,
5 reversal.
yeah, that's
Got it. I
that's
just want to
the
make sure that
expectation.
I knew the answer. I just want to make sure everybody else knew the answer as well.
And thank God I knew it.
Yeah,
You
thank
know,
God you did too.
no, I mean,
All right, Jim.
this is Elliott wave stuff, okay? And
It
I'll
is.
say this because a lot of people find it challenging. It is. They criticize it, warned it. I'll say that one third of the time, Elliott wave is really helpful. And, to me, this was one of those instances. One third of the time, you got like, well, it could either be this or that. And then one third of the time, it's, well, now you got three or four choices. That's worthless. And that's why you have to blend other technical indicators, various momentum indicators. You get into the stock market. I'm looking at things like the advanced decline line and so forth to really increase the probabilities of, okay, is in that first bucket where one third of the time it's really helpful. Well, I still need the reinforcement of other technical indicators to come to that conclusion. So if we go down and you got five down and the RSI does diverge, well, to me, that's a pretty strong argument that you want to buy oil and probably oil stocks and oil service stocks. Because if oil rallies to 82, 84 over the next handful of months, those stocks are going to bounce pretty hard, would be my guess. So,
Great analysis and great summation. All right, so moving forward, after we look at crude, we got the S&P. What are you making of this very annoying pattern? I think it's called the annoyance pattern. I don't know if there's any pattern there, Jim.
Yeah, technically, some people refer to it as a wave four. And wave fours are annoying. Why? Because you do all this choppiness in a triangle. Now, there are multiple options for wave four, under Elliott wave. All right. One of them is a triangle. And we talked about this last week. A down to that 72.37, the B up to 75.78, C down to 72.94, wave D. And so in Monday's weekly technical review, I said, okay, I think we're going to get one more dip. It'll go below 74.27. I think that will complete wave E. And then we're set up for wave 5. Wave 4s in triangles always happen in wave 4, whether you're in an advancing wave or declining wave. So this is a pretty well-defined triangle because some of them get pretty hairy and funky. And so to me, as long as you hold above 74.22, the assumption here is you're going up. Getting above 75.51 would even be stronger confirmation, Blake, because that says, oh, well, you're no longer in a triangle, you get above 75.51.
Yeah.
So that anyway, my biases, and we talked last week about the advanced decline line making new highs. To me, that just supports a more bullish outlook in the very short term. If correct, wave 5 after a triangle is a thrust. Why? Well, because you got a bunch of orders above and below the range. You take out the range, in this case should be short sales, shorts above it. You also get people, hey, it's breaking out, I got to go long. You get a spike. I think there's a potential that the CPI report next Tuesday could be the justification for that spike.
All right. Well, no, we will find out next week when things are set to get a little bit more hairy, Jim. So gold, excuse me. What do we do with gold here? I am in the camp that people are they know that 4,000 is below. I don't have, unless yields really start breaking higher, I don't have any reason to be selling gold here. But at the same time, it is struggling on making any substantial
Real
gains.
progress.
What do you think? Yeah.
Well, again, stepping back from the high of 55.94, I thought we entered a wave 4 correction from the low of December 2015. And you had an ABC down to the 4100. We had a rebound to 48.87. And then we've had this very choppy decline. And a couple of weeks ago, I noted, hey, gold is making lower lows. RSI is diverging. That's a positive. In my July 20 or June 29th weekly technical review, I said, okay, buy it under 39.60 because there was a low at 39.60. It bounced, then it got down to 39.45. And I think at a minimum, 4,300 is a target. You can see that downtrend line, in green. Getting above that would be obviously pretty helpful. So at a minimum, I thought was 4,300, 4,400 was likely. Now, bigger picture. If the decline from 55.95 to 39.45 is wave A of this triangle, and you said, well, why would you say that? Well, wave 2 of gold lasted 39 months. Wave 4 it doesn't have to last 39 months, but it's not going to be over in 5 months. So looking at this pattern, it's like, okay, wave A comes down to here. Then we get a big ABC rally that could take gold up to 4,700 or even a touch higher. In other words, you're going to retrace a chunk of the decline from 55.95 to 39.45, 50%, 618. That's going to take months to do that. And then you're set up for a wave C decline to get below either 39.45 or whatever this near-term low turns out to be. That'll chew up enough time so that maybe we're into early next year and gold will have gone through a 12-month wave 4 correction. So So, we're layering time frames, we're layering patterns within those time frames. But, if you're looking at, well, what's the road 100 feet in front of our car windshield? Well, you had an RSI divergence. It had got pretty oversold. Sentiment was extraordinarily bullish in January, and now, people are pretty negative. And so you have all the background for a decent pop. And so that's my bias is buy if it gets under 39.45, it's a buying opportunity.
Okay. All right. And is it possible that we just go up from here?
Yes.
Okay. All right.
Yeah, yeah,
Okay.
yeah. I mean, and that's why I said getting above that green trend line would
Yep.
be further confirmation. And then you're talking, like I said, 43.81 then would be the next target. But then, I just think things are set up like that you could see a bigger move.
All right. Well, let's talk yen right now. And you're talking about intervention. Yen's been in everybody's conversation recently, and
Yeah.
I keep thinking that because we're seeing, more activity in Iran again, that the Ministry of Finance and the BOJ is going to be more apprehensive about trying to intervene since there's so much aggression out there. What are your thoughts?
Well, again, going back to 1986, the yen is at its lowest level. That's 40 years ago. That's a long time ago. Also, going back to July of 2024, that's the last time they intervened in I mean, they did some intervention, what, a month or two ago, 4 to 6 weeks ago,
Yeah.
and you got a pop and that faded. Now we're making lower lows, but the sentiment is extraordinarily negative, the yen. Why? Because it's been going down for a while. And levered funds, you can see their net short position is the most since July of 20. It's more than what it was in July of 2024. You got to go all the way back to, I don't know, is that 2018? It's the low. You can see it. There's more short yen right now than any time in the last decade or longer, right? So if I'm the Bank of Japan, okay, we just took out those lows. We tried to intervene. We got a bounce. We've taken those out. You're getting more people short as a result of that. And as I noted here, in July of 24, the yen was 1619. Today it's 1626. I just think it's a question of when they come in. The 10-year yield at 290, the highest since 286. Are they going to raise rates to try to defend the yen? I don't think so. So I just think it's a question of when they're going to come in
Okay.
and be more aggressive about it. And the yen makes up 13% of the dollar index.
Speaking of the
So
dollar.
what do you know? So there's still a shot that you'll get above that. We'll test 101.80.
Well, you
And
you you were saying 107. I mean, so
oh,
are you
well, no,
still?
no, no. Well, that's like months from now. But
Oh,
I'm
okay.
saying near term
No, I
that
want to
I
see it
thought.
tomorrow, Jim. I need.
Well, what can I tell you, Blake? Stopwatch. So, no, the point being is the RSI got really overbought. And if you go back to November of last year, March of this year, what you can see is the dollar made a high, the RSI made a high with it. You had a pullback, dollar then made a subsequent higher high, the RSI didn't confirm it. And that in the lower panels, the RSI, you can see the red lines, the marking the divergence there. I thought there still was a chance that the dollar could pop and test 101.80 and kind of repeat what it did to the last two, intermediate to short-term highs. Um, it may or may not do that. If it does, it'll set up a divergence. To me, that would add even more credibility for, okay, we're going to get a deeper pullback, consume some time. I think, could you pull back to 98.38? Possible. But to your point, the longer term pattern is such that I believe a move to 105, 107 is coming.
Okay.
So,
Well, let's see if that happens. All right.
yeah, but
Last.
we take it 1 week at a time.
That's right. Right.
So back when was it in when the dollar was down at the recent lows, we were talking bullish, looking for a rally. Is that in January? Okay. When it
Oh,
got up
down
to
here,
that
yeah.
one, yeah, that 100 level, I said, okay, time for a pullback. I thought 97.50. Well, I got to, or 60, I think was a 618. Got to 90. So it's kind of like, okay, yeah, I think 105, 107 is coming, but we have to take every kind of step along the way, and work with it. And
Yeah.
that's all we're trying to do here.
All right, very good, Jim. Let's last but not least, let's talk about 10-year yields. Like I said, they look a little strong here. Not
Yeah,
gonna
they
lie.
do. And I thought we were going to see a choppy move with yields coming down to at least 431. I mean, in other words, I wasn't looking for this gigantic move. It's just like, okay, we got below 442. That implies that you're going to see a test of 431, which was the prior low, or maybe the 422 was the low before that. So not a big move. As I've emphasized, longer term, I think yields are headed higher. So we're just trying to take the near term squiggles. Getting above that 456 makes me like, okay, as long as it's above 442, I'm going to go with the next stop is 5%. And that's been my view for a long time, is that ultimately we're going to see the 10-year get above 5%. Why? Well, in October of 23, it got to, I think, 502 or right around five. I thought that was wave three then, that everything since that high is like a wave four. And now it's a question of when are we going to start to try to move up towards 5% again? So that's my take. Now, if and when we get above 5%, I'm going to be looking for a much bigger decline in yields.
Oh boy,
In other
5%.
words, we'll have completed wave one up, five waves completed, look for a retracement. Ultimately, I think the 10-year, Blake, in the next 10 years can get to 7.5. And you say, why?
No, no, take us back to ZERP. I want easy money. We
No,
all want
why?
easy money.
Because the 10-year got to 15 and a half in September of 1981. It dropped to 55 basis points in 2020 March. What's the 50% retracement of that? That's 15 points divided
Yeah.
by two is 750 plus 50, so I'm saying 750. That sounds ridiculous, but you know what? In 1945, when the 10-year was 1.25, did anybody expect that we would see it at 15 and a half,
No.
35 years
Yeah.
later? No. But so my point is that's a big secular move that took 30, actually 36 years. And then from 81 to 2020 is 39 years. So
I
again,
want
I
cheap
think there's a
money.
potential. No,
Cheap
I'm just,
money.
yeah. So again, we all love cheap money. But, that's what the big, big, big picture holds. But it's like driving a car. You're going somewhere, the road curves, you got to curve with it. And that's
Yeah.
what we're trying to do every single week is say, okay, here's the bigger picture, but let's boil it down to where we are right now and what we can reasonably expect over the next 1 month to 3 months. And
And
that's how
and
we
what
try to keep the road on the car or car
and
on the
what
road.
and what I love about what Jim does is he puts it all together. It's a combination of A, technical analysis, but B, what are the reasons why things are happening. And if you're not taking in that into account when you're trading, it's like driving with one eye closed the whole time. So Jim, I want to thank you for joining us every Thursday. Now that we're doing it in these live formats, I think it's awesome. Um, uh, uh, again, to reiterate, what's the email where people can email you to get your
Yeah.
weekly technical review?
Yeah. Jim Welsh, macro at Gmail.
How long have you been doing your technical reviews and your newsletters for macro tides?
Macro sides, I started writing a letter in the mid 80s, 19, as in 1980. All right. Back then it was called the
Jim, I
financial
was 9 years
commentator.
old.
And I was younger too. Back then it was called the financial commentator. And then around 2007 or eight or so, I went to, no, it was probably a little later than that, macro tides. Because I started to focus more on the bigger picture and so forth. So a long time. But what I will say is look, and as you just noted, looking at the fundamental side of the equation, I think is really important because I was more technically biased many years ago. And what I have found, Blake, is when I can see the fundamental reason and then the technical stuff works with it, man, I have so much more
Conviction.
conviction,
Hmm.
you know? And I think if those who just focus on the technical stuff, you're missing a big part of the equation. And that's what I try to provide, in our conversations every week and in the letters is to marry those two. And it's amazing how often things happen,
Yeah,
that
and that's what this is where experience counts, guys. So, it really does. And we're in unprecedented levels, testing unprecedented areas in an unprecedented time. And you need experience like Jim around to help guide you. So, Jim, thanks for guiding
yeah.
us every week. I appreciate you being here. And
All right.
we'll look forward to catching you next Thursday, my friend.
You got stay well. Have a great week.
All right, and everybody, thanks for tuning in today to today's Lunch Money. We'll see you tomorrow on Friday. You guys have a great rest of your day and enjoy the France-Morocco game.